All right, so good morning, and you are welcome to our next session. And this session will be on bank reconciliation statement. Bank reconciliation statement. So we take a look to try and understand what bank reconciliation statement is all about. So let's dive into it. All right. Now, what is bank reconciliation statement all about? Now, there are two parties I want you to look at in terms of trying to understand what bank reconciliation is about. Number one is the company, the entity, all right, or the business you are working for, all right, let's say, or the business. Let's say you are the accountant inside this business, or the company, or the entity. On the other hand, there is a bank, all right. So what happens is that the company, as they are operating, will go to a bank and open a bank account. That is it. They will open a bank account. And one thing you should understand is that we've already learned something called cash book, and the bank will be keeping a cash book. All right. And you remember that in the cash book, there was a bank column of the cash book. So let's say the bank column of our cash book. So that is what we have. So that means that in case a customer pays us money into our bank statement, or a customer pay or a bank account, or a customer gives us check, what will we do? We will record it into our bank column of our cash book. All right. So remember our cash book. So only bank column. So let's say bank column, the bank side only. Now you do realize that this side of the cash book is for receiving money, so receipts. So if a customer, let's say, comes, pays us a check for goods that we sold to him or her, we will collect the check and record it that the customer has paid. Obviously, you debit your cash book and you credit the customer account to reduce the balance of the customer. Basically, that is what you do. Now, you will later take the check to the bank. So that is what will happen. So you will see that. And I will show you how this thing is done in real life, in real businesses and in their offices. But here, what I'm trying to say is that the moment you receive the check, you also go to the bank and deposit it into your own account. So the bank account there that is for the business. Is for the business. Now, when you go, the bank will also have what they call their bank statement for you. It's a bank statement for you. Now, what does that mean? What it means is that any money that you put into the bank, they will also record it into your account with the bank. Now, a bank statement has so many structure that they structure it. Some of them will have these kind of headings. Some of them will have credit or deposit. Most of them are like that. Deposit, withdrawal, then balance. So that's how, and they will have the date, all right, then narration. That is how most bank statement looks like. So for example, if I have this check, I have debited here. What do you think the bank will be doing to my account? They will be putting it into my deposit because I came to deposit. So this will be where it is. It will be at this side. Anything that you receive here, when you go to the bank, you deposit. This side of the cash book is for making payments. You understand? So whenever you make payment, you are withdrawing using check, you are withdrawing from your bank balance. Good. That is it. Now let me ask you a question. This bank balance or this bank statement, the bank, to you that you are keeping it with the bank, is it an asset or it is a liability? So if it is for you, is it an asset or is a liability? So the bank is the one controlling that part. Your control is here in your cash book. That is what you must see. But that side, it is the bank that is doing it. So you really don't have such a control over there. So it will be very difficult to do that kind of analysis over there. Yet you can do that analysis in here because this is what is in your book. But the opposite, whatever you have here, the opposite is here. But you see here, the bank has not done debit and credit, so you may not understand how that part is functioning. Now, this is the balance. So anytime you deposit, the balance will go up. So let me use red ink. Anytime you deposit, the balance will go up. But anytime you withdraw, the balance will come down. So that is what you must understand. Is that one okay? All right, so that is that. Now I'm going to show you a typical example of how this bank statement looks like. But before then, let me ask you a question. If somebody pays money into your account, or if you yourself, you go and pay money into account, what is the name that the bank gives to that money? Is it a debit or is it a credit? When you pay money into your account, what do you think they say? So let me give you a typical example with my own personal example. So I went to EcoBank to withdraw money. Okay, so I will withdraw 1,000, and I also withdrew 700. And again, I don't know if you can see the first one, the very first one. If you can read it, I pay Zoom 90 cedis every month. So you could see the first line that Zoom has taken 90 cedis. If you check the second one, the money, you will see ATM. I've gone to withdraw the money at ATM. You see cash withdrawal, ATM. Then again, cash withdrawal, I did another one. That is 700. So what do you see the word? Do you see any debit or credit there? So you see, anytime you go to the bank, you withdraw money or they use the money to pay something on your behalf. I'll tell you what the 90 cedis is about later. So you see clearly that anytime I withdraw, the technical word they use for it is what? A debit. So you can see that the account has been debited as you see there. So you see 1,000 debited from. Have you seen that? 1,000 debited from. So it means that anytime you are withdrawing money, they call it a debit. And anytime you deposit money in there, they call it a credit. So basically, that is what you see. All right. So that is that. So I hope you understand it now. Now that anytime you receive a check or somebody pays you money, you will debit it in your company's cash book. Whenever you deposit that check or whenever a check is deposited on your behalf in the bank account, what they do is that they will credit you. But if you rather withdraw or use the money to pay something, they will debit you. Now, let's take a look here. I'm going to show you something. This is a typical bank account of a company. It's a typical bank account of a company. Now, you see, in August 2024, they made a transfer to pay payee. Have you seen that? That was like a salary payment to the staff. So you see credit amount, debit amount, and clearly you see this is a debit, which means, and they've added minus to it, which means that it is reducing your original balance. You see another one? it is reducing your original balance. So you ask yourself, why is the bank on that same day treating the same transaction all the time? Because a payee is actually like a salary sort of, but the idea was staff salary, but the way they've treated it to GRA customs, and this one too. So let's say this one was probably a custom duty or something. All right, so let's see that. But they've done it 3 times. They've deducted the money 3 times. And you see, another one, 4 times. So what should that tell you? Probably the bank is making mistakes. So you see, when you come here, the thing should be one time. So when you come here, you see what they've done? They've reversed it, reversed it, reversed it. So these are things that we will be learning. Some of the things that goes into the cash. They have made mistakes, so they are reversing. You see this one too? They are reversing. But have you seen that when they were reversing this one, there was 893.00, but what was actually here was 892.99. So it means that there will be a difference of 0.01. So have you seen that? All right. So that is that. This is a typical bank statement. There is a credit amount, which is the depositing amount, which is in positive. There is a debit amount, which is reducing the balance. But watch this. You saw this balance. It's in negative. The moment they did this, the balance negative came down. They reversed this. You saw this. They saw until they reversed, and the balance is 558.7, just as it is here, but with only difference of this 0.01 thing that is here. All right. So you see the difference. You see it here. So this is a typical bank statement. They have the date. All right. The date, booking date, value date, reference, narration, debit, credit, debit, and balance. So anytime amounts go to the credit side, it is increasing your balance. Anytime amount go to the debit side, it is reducing your balance. So now, if you are a company, you have already understood that I said that any money that is at your debit side is supposed to be at your credit side of the bank statement. So when it is at your debit side, it's supposed to be at the credit side of the bank statement. When it is at your credit side and it is a payment, it's supposed to be at the debit side also of your bank statement. So at the end of the day, the two should always be the same. The two should always be the same. Because if the money that I have at my debit side should be equal to the money that I have at the credit side of the bank statement, then at the end of the day, it should be the same. But unfortunately, it is always not the same. So that is the reason why we are doing bank reconciliation statement. We need to agree them together. Now, what are the reasons why these things will happen such that the bank statement and the cash book, bank side of your cash book are not the same? What will cause that? What will cause that? And I'm going to give you a different, you've already seen some of them now, that sometimes the bank can make mistakes. So you saw the mistake the bank did, that even when they were correcting the mistake, this is the mistake they did. And when they were correcting it, you saw that they corrected it in such a way that there is a 0.01 difference in there. But where is the cash book of the company? This company has an Excel they are keeping as a cash book. So this is the company's account. Now watch this. Look at the balance in the cash book. Look at this balance. And look at the balance in the bank statement for the same month of August. So this is the August. And look at the, so you see 29686.48. 2968, all right, 6.48. But let's go back to what they have in here. So what they have is 47848.7. So it means that it is not agreeing. So the reason being this, we will have to prepare a bank reconciliation statement. But let's ask ourselves, what caused the difference? So let's look at some of the causes of the difference between the bank statement and the cash book. between the bank statement or between the cash book and the bank statement. All right. So what are some of the causes of the difference? So now, what do you think will happen? A typical example that will happen, you've seen it, is an error. So you saw that the bank made a mistake. So you can have bank error. All right, you can have that. Yes, what else can you see? You saw that I showed you my text message about a 90 cedis that was deducted from account. So every month I've given my bankers a direction that every month they should pay Zoom 90 cedis so that I can be using the Zoom just as I'm using to teach here. So every month I pay Zoom 90 cedis. So it is an order I have given my bank. So if the bank does it and I have not recorded it in my cash book, so the bank will debit my account. So which means I'm supposed to credit my cash book. All right. Now I've not done it. So it means that at the end of the day, my cash book will not balance with the bank statement. Why? Because I've given an order to the bank, all right, to do that, but I have not recorded it in my books yet. So that one, we call it a direct debit, or a standing order, All right. Another thing that can arise is that somebody also paid money into your account, but the person didn't tell you. The customer paid it into your account directly, but it didn't tell you. So that one will also be what? A direct credit, or we call that one to a credit transfer. So a direct debit is when you give an order to be made. So sometimes company gives uh, an order to their bank to pay dividend. All right. So sometimes dividend payment, other times dividend received. So you can liken this one to a dividend payment where you give an order to your bank to make a dividend payment, but you have not recorded it. Or this one to a dividend that you are receiving. All right. But the people didn't tell you that they paid a dividend. For all you know, they paid it. So this one can cause that. Is that okay? Other times too, a customer will pay you some money in check, you take into the bank. So when you take the check, what do? You debit your cash book, right? And you credit the customer account. But all for you to take to the bank, and the bank says they've dishonored the check. So that one too is another thing that can happen. So we call that one dishonored checks. Dishonored checks. But ultimately, what is the question? Why did the bank dishonor the check? We will try and look at some of the reasons why a bank would dishonor a check. Why would you think you would take a check to a bank and it will be dishonored? Let's look at some of the reasons. A typical reason is that you don't have much fund in your account. It's like going to do Momo. Say you are going to withdraw, and when you go there, the money is not up to how much you want to withdraw. So we have what we call insufficient fund. Insufficient fund. You don't have much fund. All right. Number two, they said when the amount in words is differs from the amount in the figures. So amount in words differs from the amount in figures. That one too is possible. Even the pink sheet, even the pink sheet, if the amount in words differs from the amount in figures, the pink sheet is rejected. Is that not it? All right, that's it. So these are two. Again, the check may be a stale one. Stale check. Sometimes people call it expired check, but the correct way to look at it is a stale check. What is a stale check? A check that has been with you for more than 6 months. For more than 6 months is a stale check. So take note of that. It's more than 6 months. So when you take it to the bank, then they will dishonor it. You have to take it back. Again, another reason why a bank will dishonor your check is that you have insufficient mandate. And I will explain that one to you. Insufficient mandate. Anytime a company goes to open an account, they tell the bank there are about 2 people who should sign on the check. Now, if you told the bank that 2 people will sign on the check, and when you take the check to the bank and only 1 person has signed, they cannot give you the money because the mandate is insufficient. So take note of that. Again, if you take a check that is a post-dated check to the bank, the date on the check is a future date. You took it there today. So somebody gave you a check. The date he put on the check is 31st December. And you think you have money, so you've gone to the bank to withdraw. When you go there, they'll tell you that the date of the check is not due, so they can't give you the money. So anytime somebody is giving you a check, make sure that you have the present date, all right, or a past date that is not more than 6 months, all right. Take note of that. Then again, we want to look at the fact that the signature is not what they have in their system. So signature differs. When the signature differs from the bank specimen, so they will give you, when you are opening an account, you sign, all right. So that signature that you will sign, anytime you are going to withdraw the money, they will look at that signature, all right. So that is that, and check if they should give you the money, because if it is a different signature, they shouldn't give it to you. It's not you. Or if there is no signature at all, if there is no signature at all, because if you don't sign, there is no way they are going to give. Sometimes, even when the figures are so deepened, no clarity, all right, so deepened figures, the bank can tell you that deepened writings, the bank can tell you that their system couldn't pick it, they will reject it. So these are the reasons why a check is possible to be dishonored. What are some of, let's go back to the other reasons why there will be differences. Another reason likely to cause the difference is bank charges. Bank charges. So it's possible that the bank will charge you something, and I will show you an example. So all the time, the bank is charging. So you see 60, they charge. And look at the day they charge. It's always almost the last day of the period. So if you don't record it, your bank's cash book will never be the same with your bank statement. So in same vein, bank interest, they can also charge you interest. Bank interest charge, sometimes they charge you on internet use. Or you can also receive interest. So bank interest received. But you are not aware until you open your bank statement to check. All right. So basically, these are some of the things that can cause the differences that you can see inside your. But not only that, let's say you give your customer a check. So a supplier a check. You gave your supplier a check. The supplier is going to, you're supposed to take the check to the bank to withdraw, but the supplier didn't do that. But you immediately gave the check, you recorded it on the right side, your credit side of your cash book. Now, since that person has not taken it to the bank yet, it means that your balance has not been reduced. So we call those instances unpresented checks. Unpresented checks. It's nothing difficult. All that it means is that you have given the check to someone to go and present it to the bank and collect the money out of your bank account, but the person just have not done that. Basically, that is that. So that means that as you have, let's say you issue a check to a plumber, you pay the plumber. So immediately you said plumber, 5,000. Now, the plumber is supposed to take the money to the bank so that the bank can also do 5,000, but he hasn't taken it there. So yours has been your money, your cash book money has reduced by 5,000, but because he hasn't taken it there, your bank account has not reduced. So it will create a difference. All right. So that is that. Then what else? The same way, if a customer gives you a check in your cash book, what will you do? You will debit your cash book because you have received a check. But it is up to you to take to the bank so that the bank will credit your account and increase your bank account balance with the bank. But you have not done that. That one too is called uncredited check. So it is you receiving a check which you have recorded in your cash book, but you have not taken it to the bank. So basically, that is that. But interestingly, you too, you can make an error. So when you make an error, so this one is errors by the entity. Is that not it? So that is that. You too, in your cash book, you can make error. Sometimes when you are recording 1,005, you can make a mistake and write 1,005. Or you can even write 5,100. It's all mistake. These are all errors. But that error is made by you, the entity. So these are the differences. Ladies and gentlemen, now we classify these differences under two broad headings. All right. We have timing differences and we have informational differences. Now, which one do you think is timing difference and which one do you think will be informational difference? This one is called timing differences because very soon the bank will realize their mistake and correct it. Did you see in the bank statement that I showed you? They realized it, they correct it. So it's just a matter of time. Unpresented checks, it's just a matter of time the person has not presented the check to the bank. Very soon, he will present the check to the bank. So we call those one timing difference. You too, when you collected the check, maybe you recorded it today, but tomorrow is when you will take it to the bank. So it's just a matter of what? Timing difference. Then we have informational differences. This one is called informational differences. Why do we call it informational differences? Because, for example, this is an information that the bank has, you didn't have. But later on, you will realize it when you are told. So by the bank. So that is that. We call these ones informational differences. All right. So these are the issues that surround what makes the bank the bank statement different from that of the cash book. All right. Now, what then do we do to bring the two balances together? We need to reconcile it. We need to reconcile it. So this error, some people call it casting errors. They give names to it, but whether it's casting error, non-casting error, whatever, it is still error. So what are we going to do? What we will do is that we will correct these informational differences are corrected in the cash book. Why? Because they are already done in the bank statement. The bank did the payment or receive the dividend. So they've already been done by the bank. So we will do it now in our cash book. Bank charges has been done at the bank. The bank has done everything that they will do with this information. We have not gotten the information yet. So now we will take the information apart from this error we have committed. And even the error we commit, we will also correct it. All right. So basically, that is that. You can as well even classify errors as part of the timing differences because very soon you will spot it and you will correct it. Is that okay? So errors, you can say they are timing differences. But there are errors made by the bank and there are errors made by the entity. So errors made by the entity is something that we add here, but it is a timing issue because very soon you will see it. Is that okay? So that is that. So you correct your cash book. But the problem is you already prepared your cash book. So correcting the cash book, you have to prepare another one called updated or adjusted cash book. That is what you will do. Then you will use the timing differences to prepare an account called bank reconciliation or a statement called bank reconciliation. Statement. All right. So basically, that is that. That is all you're going to do. Now, how do we do the bank reconciliation statement? We said first, you must prepare an adjusted or updated cash book. Is that not it? Using the informational differences information. So updated or adjusted cash book. So you know how we do a cash book, is that not it? So this is it. All right. So what was your balance in the cash book? So if your balance in the cash book had a debit balance, you bring your balance brought down over here. Now, which of the balance brought down is this one? It is the closing balance. The closing balance. The closing balance that you had before, that is the one you use. But if your closing balance was a credit balance, we call it overdraft brought down. All right, so that is that. Then the information that you have in the informational differences, you are going to bring them in here. So first of all, let's take one. When you take direct debit, what do? The bank debited you. So what do you think you will do in your cash book? You will credit your cash book. Is that not it? So direct debit, or another name was what? The standing order. Conversely, the direct credit, where the bank has credited you, or the credit transfer, will be here because the bank has credited you, so you have to debit yourself. That is it. All right. So what else is left? Dishonored checks. Good. When you received the check, what did you do? You debited it. Now that it has been dishonored, you have to remove it back. Dishonored checks. Then what else do you do? What do we have? We have bank charges. So the bank, what do you do? What do you think they did? They debited you, so you credit. So bank charges. Then the next one is interest charge. Then bank interest received. So if they charge interest charge, it's just like a bank charge. Then interest received. That's it. All right. Then what else is left? The errors. So if the error has to be corrected on the debit side, you correct it. If the error has to be corrected on the credit side, you correct it. So whichever place the error has to be corrected, you correct it. So basically, this is what you do. Then after this, you are going to balance of the account. Balance of the account. You know how to do balancing of an account, right? So you total, you find where the bigger difference is. All right, then you put it in. The thing is that the balance brought down can be here, can have a balance brought down here, which means that the balance carried down of that brought down, the balance carried down can be here, which means the balance brought down will be here. So, and that balance is the adjusted balance. All right. But sometimes, if it is an overdraft, the balance can also be here. So you can have an over balance carry down here, depending on how the balancing will go. So balance carry down to can be here. And the balance brought down for this one will be here. So that is that. But you see this, and if it's like this, then it means it is a liability sort of, because bank is the cash book is an asset, but asset should have a debit balance. But if an asset has a credit balance, then it means it has turned into what? A liability. So now, when we finish, we now do our bank reconciliation statement. Bank reconciliation. As at, and you put the date, the time. Put your CD signs. Put your CD signs. Then you start with balance as per adjusted cash book. So the balance as per adjusted cash book, if the balance was here, like this, or this, so this one, or this one, you will leave it as a positive figure, just that. However, if it was a credit balance, then you put it as a negative figure overdraft, because this one is not a T account, it is a statement. So you put it as a negative figure into bracket. All right. Yeah, because there are so many forms people do this, but I want to make it just simple. So if you had your balance brought down as a credit balance, just put it in negative. But still, write balance as per adjusted cash book. All right. Then we will add our unpresented checks. Why are we adding the unpresented checks? It's a simple analogy. Because we took the money from our cash book. So our cash book has been reduced. But the person has not taken the money to the bank, the check to the bank to withdraw. So it means that what we added to we subtracted from our cash book, the bank has not done it. So all that we are doing is, since the person has not gone to the bank to reduce the balance, we are adding it back to our own, because it's assumed that the money has not gone to the bank yet. So we will add it back to our cash book, because already in that cash book, it has been taken out. So we are just bringing it back, so that we will assume that no check at all was given to anybody. So we will add that. We will add that. Then we will add the errors. Errors that are resulting in an increase of our bank balance. We call it wrong credit. But always understand that if the bank does something, you realize here, we said here that if the bank credits our account, if the bank credits our account, our balance will go up. So our balance here will go up. Now, since our balance has gone up, we are going to assume that we are also adding it to our cash book, because the bank has added something to our account. We have not. So we will add it now, so that we will be at par. Have you seen that? The bank added, we have not. So we will add it to our adjusted cash book, so that we will be at par. All right. So that is that. In the same vein, you will less. So let's add this one. So sometimes the uncredited checks or unpresented checks are plenty, list them, add. Errors too may be plenty, list them, add. So I get this figure. Then I will less all the uncredited checks. Why are we lessing all the uncredited checks? from our balance here, because we received the money, right? But we have not taken it to the bank. So our bank does not have the money. We have the money. So we are taking it out so that we will be at par with the bank. So the bank has not done it. We have done it. We are undoing it so that we will be at par with the bank. All right. So that one too, you list them and you take them away. Then errors resulting in a decrease of our balance. So that is that. So this one too, we can say a wrong debit. So if the bank debits you wrongly, of course, you see that it is going to reduce your account. So if the bank has reduced the account, we haven't, so we just do it. Don't forget, the only power we have is to do the things at our side. We can't do the things at the bank side. We have our cash book. We can only do the things at our side. So this is the only things we can be doing. So you add that one together, you subtract from this. And the balance that you get here is called balance as per bank statement. So basically that is that. All right. So this is how you do your bank account. So you see that in the typical case that we have, that I showed you, started with the cash book balance. Do you remember the cash book balance? So this is a slide. So I think there's a slide mistake. Yes, because the balance shouldn't be. Let me see. If you take your August, you see July, sorry. So if this is July's balance, then the balance brought down here should be equal to the balance carried down of July. So when you, let's see something, you see it has changed, which means that I need to take time and look at the things here and do them. So that is a typical situation, errors. So once I did that, you see the balance is changing small. So that is only if this balance is correct. All right. So that is that. So investigation has to be done so that you see the errors from that side. All right. So basically, that is that. Now, but what I wanted to show you aside that is these ones. You see, these are all unpresented checks. You see that in their cash book, they've said they've issued all these checks, including this. They've issued the checks, but it is nowhere in the bank statement, which means that those people have not presented it for the monies. It was nowhere here. It's no more at the debit side. So it means they are unpresented. So you add it up. All right. And you saw this difference. That means there's an error in the cash book. So this difference, the difference that is coming from the 0.001 here, the mistake the bank did here, you see. So what do you think this one is happening? What kind of error has been made by the bank? You see, they've made an error such that it has increased your balance. Is that not it? So when they finish correcting all the errors, here is 0.7, here is 0.6. So if there is an error resulting in an increase, then we should add here error resulting in an increase. So bank error resulting in an increase, just at 0.01. So it means that this figure, I just need to add it here. So once it is added here and you go down, see it has balance. So that is what we do in the offices. What you learn in classroom is the same thing we do in the office. So learn it well so that when you get there, you won't be found wanting. Is that okay? All right. So that is that. All right. So now the last thing probably you need to do is to take some example and do. But let me just run you through this one because this is the most likely one you might be facing in the class today of this recording. So it says that the cash book showed a balance of 20,000 as at the end. So don't forget, we said when you are doing this one, which balance do you use? When you are doing your adjusted cash book, which balance do you use? The closing. So the cash book showed, all right, the balance. But what kind of balance is this? At the debit side or the credit side? Obviously, this is a cash book. Automatically, it should be at the debit side. Automatically. But if it's an overdraft, the examiner will tell you. All right, so we will solve this question in the next video. So investigation, credit transfer, you know what to do. Is that not it? A check drawn by the business had been entered in the cash book. So this is the check, 10,500. But so it means that the payment side of the cash book was supposed to be, the payment side of the cash book was supposed to see a recording of the 10,000. How much is that? The payment side of the cash book was supposed to see 10,500, but they did 15,000. So how then do we reduce that 15,000 back to 10,500? You find the difference. Where's my calculator? Find the difference. So this is my calculator. So 15,000 and 10,500. The difference is 4,500, which should be done where? At the debit side, so that it can reduce that 15,000 to this figure. That's all. A receipt side of the cash book has been understated. What is the receipt side of the cash book? I told you these are the receipt side of the cash book. And if it has been understated, that same debit side, add your 25,000. All right. Standing order in terms of insurance, mine was a Zoom. These are other things. So credit side of the cash book, you just do that. Checks drawn on 31st has not been submitted for payment or as payee totaling this. This is what we call unpresented check. So you know where to do it. Check received was returned due to insufficient fund. Dishonored checks. So you know where dishonored checks will be. Is that not it? So when we are solving this question, it should be simple. All right. So that is that. Because when we received it, we recorded it here. All right. We recorded it here. This is the receipt side. So if it has been returned, then it means we need to reduce the amount. Credit transfers received by the bank, but not yet entered into the cash book. This is credit transfer. Checks received from customers amounting to this in the cash book were not credited, so uncredited checks. So we do it in there. Then the bank charges, so it has been done. Then it means we will have to do it here. And the last one is check of 77,000 by Nyamiche was entered correctly into the cash book, but debited in the bank statement. So this one, what will happen? Is debited into the bank statement as is an error of the bank. You see, Nyamitie, this company is what? Nyamitie. So Nyamitie pays somebody 7,000. So which means that the deposit or the withdrawal side of the cash, the bank statement is supposed to go down. This one, they need to record 7,000 here, but they recorded 700. Is it an error that is causing your balance to go up, or is an error that is causing your balance to go down? If you are supposed to reduce me by 7,000, but you just reduce me by 700, then it means you have increased my figure. Is that not it? So it becomes an error resulting in an increase in my balance. That is it. So a wrong what? A wrong credit. So that is it. In as much as they told you debit, analyze it where you will see that it will be an error that is resulting in an increase of your balance. So you bring it here. So this is a simple example. We'll look at it in our next video. Thank you and see you in the next video. Bye bye.